the real story, what's really going on at an eight-figure Amazon e-commerce business, dealing with the tariffs, dealing with all the uncertainty this year. Joining me today is Bernie Thompson. He's the founder and CTO of Plugable Technologies. He's been selling on Amazon since 2009. He even was highlighted in the Amazon shareholders letters by Jeff Bezos. Like that stuff is super valuable. There's like it's been in like books, and then not only that, Bernie also wrote the book on selling on Amazon, Flywheels and Feedback Loops. Welcome, Bernie. How is it going?
Great, yeah, great to be on and great to see you again, Gary.
Yeah, it's a pleasure. I mean, Bernie has been an alumni speaker at Seven Figure Seller Summit. He was on the very first summit. He's also come to Japan, coming to our Japan mastermind. But I think it's super critical to understand what's really going on right now. We're in going into Q4 2025, there's been a ton of news about the tariffs. Like recently, there was like more developments, and Bernie actually sent me this Financial Times article last night, so we got a lot to cover. And I want to like really help you understand, how the tariffs are affecting a very large Amazon eight-figure e-commerce business. So, just to get started, Bernie, I understand you started selling on Amazon in 2009 with Plugable. I mean, you don't have to give us the whole story, but like basically, before we talk about today, maybe you can give us like a quick overview of like, the evolution of Plugable. I know you're doing eight figures, you're selling in multiple marketplaces, and, also like your sourcing supply chain. I mean, like I know it's shifting. I believe you're in like Taiwan, Thailand, and Vietnam. Maybe if you can just give us like quick 2 minute overview how we got here before we unpack what's going on today.
Yeah, absolutely. Yeah, I was really fortunate to start this. I was starting an electronics company. I didn't think I was starting a kind of an Amazon company, and we don't think of ourselves as an Amazon company today. We're omni-channel, but very fortunate timing starting in 2009. I don't think I could have started the same company just a few years later and succeeded, but we did have that good timing. And so we kind of had 5 or 6 years of kind of unfettered growth where, as fast as we could scale up our product lines, scale up our brand, Amazon was there, this monster growing, feeding us those early years. And then, starting around 2015, 2016 or so, you started to have this kind of rise of the dominance of Chinese brands. And that's really continued through. There was a little kind of lull during the pandemic as everybody was disrupted, including the Chinese brands. But today in my space, many of my Chinese competitors, they're public on the public companies on the Shenzhen Stock Exchange or the Hong Kong Stock Exchange. I'm still a private company, operating at a much smaller scale. They have grown, you know, past me and dramatically exceeded what I've been able to do, as a Western brand.
Those are
Um,
brands like Anchor, like the ones we're very familiar with, right?
yeah, Anchor and Edify and Ugreen and all these brands that were these little upstart, kind of the early five character brands. They're now public companies. It's
Mm-hmm.
amazing to see it happen. And then you have the what we're going to talk about today, which is this kind of backlash on the U.S. side to this dominance by they're not aware of kind of what happens at the brand level, but just this trade dominance that China has. But then, as it's turned out, and this is really really interesting, you know, uh, we have a little bit of a madman regime here in the U.S. right now, and they're not just going in a focused way after our most important competitors. They're going after our friends and allies and kind of everybody too. And so, one of the difficult things for us right now is we spent about the last 8 years getting most of our production out of China, as you mentioned, into other countries, and the countries that have the capability to cost effectively produce electronics are almost all in Asia. So we're kind of scattered around Asia right now, which sounds good, except now the new tariffs that were just announced last week or formalized the August 1st tariffs, they pretty much hit all those Asian countries pretty equally and pretty heavily. And we can talk about the differences in rates and the details in that. But in short, a lot of companies like mine that made these really high risk, heavy investments to get production out of China, we're now our advantage has been potentially taken away. Um, Now there is one thing in my world which is really important, which is there's still an exclusion on a lot of electronics, on phones and computers and a lot of the products that we sell. So we're currently at a 0% tariff rate on a lot of products, and we expect that to end at any time. We don't know when. And so we're getting a temporary advantage being in the category where of product that we're in. But we can talk more. That's not going to last, and we can talk more generally about how these tariff rates affect everybody.
Yeah, yeah, that's a great overview. And for those of you guys watching on video, I actually have a pluggable um, Mac, like USB-C dongle dock. So this is what the type of products that they make, and yeah, just to give you an idea of that. Okay, so leading up to right now, August 1st, we had some developments, like new tariffs. So can you give us an overview? I mean, okay, before we talk about the tariffs, how is Plugable doing? Like in terms of like your sales, are you still achieving profitability despite the tariffs? I mean, how does it look like on a high level?
Yeah. So again, for the tariffs, we are in a fortunate position that all of the products that we're highly successful on are currently at a zero rate.
Hmm.
There's chargers and cables are not exempted, but we've gotten blown out by the Chinese brands in those categories on Amazon largely. Now we do have a business off Amazon, and we're continuing to we have to raise prices to match the tariffs there,
Mm.
but those markets are less price sensitive, and everyone and it's more established brands, and so everyone is just raising prices there.
Mm.
But for
Bernie,
our
sorry, when you say business off Amazon, what is that exactly? Is that like a Shopify store, or are you like offline retail?
Yeah. So there are and we're pretty US focused, or at least North America, US and Canada focused for our sales
Hmm.
channels. But there's these
Hmm.
long established electronics distribution channels. You've got big distributors like Ingram Micro, TD Synnex, and others that distribute out to other online stores, physical retail, but the big one is they distribute direct out to corporate. And so you've got value added resellers and integrators and large corporations and government and education. So that's all of that. And we're in all of those channels with our
Hmm.
products. And
Hmm.
it's an important diversification away from Amazon, but it requires quite a bit of scale to get into
Okay.
those. They tend to only work with big established brands, and it took a long time for Plugable as a relatively new brand starting in 2009 to break into all those channels, but we have.
Right. Okay. And what about prices? You said that you're raising your prices off of Amazon. Is that right?
Well, we're raising our prices everywhere where
Hmm.
we have tariffs. What's happened for us is the products that have tariffs are the same ones that already we couldn't compete with the Chinese brands on. Cheap cables, chargers. That's 100% Chinese brand market on Amazon. And so we don't, if we were in a position where we had a large market on Amazon and then we were raising prices, we would lose our market. But we didn't have the market to begin with.
Okay.
All our market is kind of off Amazon. So we're kind of,
I see.
again, kind of in an odd position, which is, I guess kind of favorable in a sense that the tariffs haven't hurt us relative to our areas of strength.
Okay. Okay. But that was for the exemption for
Yeah.
electronics, but I believe that's temporary, right? So like what do
Yes.
you see coming after that?
Yeah. It's tough. I mean, so and it's tough for, and this is the situation that most brands are in right now, that they're not falling under some exemption, and
Yes.
so basically you got a couple different big things about that. Well, one is that the tariff rates are settling in slightly higher on China, anywhere depending on your Section 301 tariffs, the tariffs from the first Trump administration. You might be at 30 or you might be at 55 for a lot of products are in that range. Whereas for all other types of, or all other countries and types of
Hmm.
products, the tariffs have settled in generally between 20 and 30. Like so, Taiwan, Vietnam and Thailand are all right around 20. Um,
Okay.
so
I'm just going to share
uh,
screen, Bernie, because the article you sent me had this chart with the Asian economies hit by Trump's reciprocal tariffs. Can you see this on screen?
yeah, I can. Yeah, and I hate that name
Okay.
reciprocal because this there's no reciprocality here. This is
Right.
like reciprocal only in the sense that I give you a bump and you stab me. Like that. It's
Yeah.
reciprocal in that way. But
Yeah. That is.
anyways, yeah, that those are the current rates.
Okay.
So one of the big things to note is that, and this was the article that we're looking at, or that this came from, which is that really all big companies that make big investments in getting out of China are looking at the value of those investments significantly degraded by these tariff
Hmm.
rates because there just is not enough of a differential between China and the other countries. We all made compromises to get out of China. The infrastructure for manufacturing of physical goods in China is amazing. That
Hmm.
it's hardworking people with all the right skills and all the right equipment, and kind of getting all of that out of China. You ended up basically taking a higher cost structure. And so the tariffs, the original Trump tariffs, were compensating for that higher cost structure of producing outside China. But now this new tariff regime, as of August 1st, makes that a lot more questionable. It still may work out, but it's a very close call, and a lot of businesses are reconsidering. And in fact, we're reconsidering. We have some products that we were kind of our last few products that we were trying to get out of China that were difficult to get out. We're basically
Hmm.
now looking at these tariff rates, going, well, they should just stay in China. And either there's a market for those products at those prices with the tariff cost of tariffs included, in which case we'll continue the product, or there isn't, in which case we'll discontinue the product. And we've discontinued quite a few products already, and there probably are more to come, because after the tariffs come in, that we're not price competitive. So then that leads
Yeah.
into a second big thing, which is, well, why would that be? Why would Plugable it should be a level playing field, right? Everybody's paying the same tariffs.
Hmm.
Unfortunately, that's not true. And so there's two basic ways that it's not true. One is just even legally, not even talking about tariff avoidance strategies. Um, if you're a Chinese factory and you're shipping goods to yourself, one of your own entities in the US, what you put on that commercial invoice, you have a lot of flexibility for that. You absolutely do not need to include your profit. You can shift that to the US and not pay any tariff on that. And it's probably unauditable how much your labor costs are and some of your other input costs. And so basically, you can fairly safely take those off the invoice and not, have those get included in the cost. So whereas for any foreign brand buying from a factory in a country like China, you're sending a bank wire over there. Your commercial invoice ultimately needs to match what you're really sending, and you can't play games. And then if you're a U.S. company and you're talking about U.S. tariffs, you are legally reachable. You will never escape Customs and Border Patrol. I mean, being in business 15 years, we have several issues with Customs and Border Patrol involving them wanting hundreds of thousands of dollars from us on good faith, where we were trying to do the right thing, going back 5 years, 10 years. So if you're a U.S. entity, you have enormous risk if you are even playing within the gray areas of this stuff. Whereas if you're a Chinese entity, you just disappear and you come back in a new form. Very easy to
Hmm.
do. And that's
Yeah.
actually some of the same reason why Chinese brands have done so well on Amazon is that ability to do black hat stuff, and then if they get caught, come back in a new form. Great example of that being Aki, banned from Amazon in 2021,
Hmm.
went public last year as AU Group, with tons of Amazon business, that they're doing. So,
Yeah.
that even they're a public company, so it's extremely visible what they're doing, and
Hmm.
anybody here, any viewer can analyze, AU group and
Mhm.
see, they can come back in a new form and not get punished. So, anyways,
Yeah.
so then on top of that, kind of white or gray ways that a Chinese brand pays less on the same good, or a factory brand pays less on the same good. You have all the black ways, just misdeclaring HS code value, misdeclaring the value on the invoice. It's basically a self-declared tax. Like whatever I put on the commercial invoice is what I pay tax on.
Yep.
Well, I mean, there's a long history with global trade of anything that's self-declared. The Chinese brands are very aggressive about gaming them, and lots of other people too. I mean, it's not just a Chinese ethics thing, although there is a strong uh, a compelling desire to win on the part of Chinese companies that is has a different character than a lot of other ones. But anyways, so the net of all this is that this tariff structure as of August 1st is really not a good thing for any US brand or really any global brand that's not that is sourcing from elsewhere and selling in the US.
Yeah. I mean, I agree with you. It's just like it's very hard to go after like foreign entities. I mean, not just Chinese brands, but any foreign entity that are importing US because like US doesn't have like, a lot like, jurisdiction to do that. I mean, but at the same time, like keeping in mind like people listening, people tuning in, I mean, what can they do given these new round of tariffs? I mean, we saw the graphic earlier. It looks like China's going to be 30%. Obviously, this could change, and but the rest of the Asian countries, like India is 25%, Taiwan is 20%, Vietnam is 20, Cambodia is 19, Thailand is 19, and Japan and South Korea are both 15. Like, what what can people do? I mean, what advice would you give?
Yeah, it's tough because some of those differences in rates, basically between 15 and 30, they're not stable. Like most country of origin decisions, even if you're not setting up a factory, just if you're sourcing a product, it's a multi-year decision. And certainly if you're setting
Yep.
up a factory, it's a multi-year decision. And
Yes.
and and the pattern that's been set by the Trump administration in the U.S. is decisions don't have that sort of time frame. Like we can't count on these decisions sticking around for as long as it takes for us to even change suppliers, not even talking about actually moving a factory. So
Mm.
one thing to say is, unfortunately, you can't be too reactive in that way, in the long-term way. Um, Now, in the short-term way, it's really interesting. I mean, one of the things that we've been monitoring really closely is, the tariffs in some of these categories um, for goods with an origin of China already went up a few months ago, right? So this new round on August 1st is about the non-China, the China tariffs or tariffs on China's origin were largely in April. So
Mm.
have prices in the US gone up from Chinese brands since the tariffs increased? And interestingly, in our space, the answer is mostly no. So what
Mm.
that says to me is that they've found ways to avoid the tariffs. Some of it might be that they've taken a profit hit, but we know the profits of one of the reasons why Chinese companies succeed is because they are so aggressive about their margins. They're really, they live with margins that we wouldn't tolerate. And so they don't
Mm.
have margins to give. I guess that's another really important point about this tariff regime for selling things in the U.S. is these tariffs at certainly at 30% and probably even at 15%, are often larger than the total profits in the supply chain. Like so a lot of our China goods are at actually at 55% because they're at 30 plus the 25 from the original
Yes.
Section 301 tariffs. So at
Mm.
55% tariffs on the cost of goods, they are absolutely, there's more tax than there is total profit in the supply chain. So there's
Mm.
no way for that to somehow magically get taken out of company pockets. It's gotta, if people are actually paying the tax,
Mm.
prices have to go up. And
Mm.
yet we've seen prices not go up in proportionately, which again says to me that um, people are finding ways to avoid the tariffs. So, so in terms of advice, it makes it difficult because I'm not going to avoid tariffs. I'm a U.S. person. I run a U.S. company. I have too much at stake, and if I don't get caught this year, I'll get caught a few years from now, and then
Yep.
they'll go back in time.
Yep.
And so I have to operate under the rules I'm given. And so for
Mhm.
me, there's very little choice, and it's kind of that mindset I was talking about earlier. We just need to, you know, if tariffs go up, prices go up, and then I just got to see, how much of a market remains at that higher price. And I'm cognizant that as a U.S. entity, I'm probably competing against other brands and companies who are not U.S. entities whose prices probably will not go up as
Right.
much.
Right. Okay. Okay. One other mention in the article was about transshipments. It said that there's a blanket 40% tariff on goods transshipped from China to U.S. via third countries. Does this affect your business at all?
Yeah, it might, and it's interesting because this is a completely new concept.
Mm-hmm.
There was no such concept of transshipment in, as far as I know, any country's duty rates prior to this, or the World Trade Organization.
Mm-hmm.
So, I think it's like a lot of Trump things, it's going at something real, which is that, especially Vietnam, there's a lot of Chinese brands who quickly opened up factories just across the border in Vietnam. We're doing most of the subcomponent manufacturing in China, and then just doing the most minimal type of assembly in Vietnam, and then calling it made in Vietnam. And by the way, because Amazon still to this day only supports China as a country of origin for AGL and other goods, they were often then shipping the goods back into China to go out a Chinese port to get to the U.S. and get to Amazon, which is kind of funny.
Mm-hmm.
But the goods were labeled made in Vietnam. So they're going after that concept that at a product level, um, that there's this kind of faking of country of origin. But then as they've been revealing more about their definition of transshipment, it's also at the subcomponent level that if you include subcomponents in a product that are individually sellable, and let's say that subcomponent comes from China, um, that you would pay that 40% kind of transshipment rate on that subcomponent. And there's a similar thing going on with certain input materials like copper and steel and
Mm-hmm.
aluminum, where you're, in addition to the tariff on the good at the HS code of the good, you are also obligated to pay a tariff rate on your materials, like how much copper you have in the product, which is really hard to calculate and therefore really easy to cheat on, and will cause even more of this effect. Any tax that's based on self-declaration and is hard to audit and hard to calculate is just an invitation for people to declare whatever they want to declare. And this may happen with transshipment. This may happen with some of these, metals specific tariffs that they've put in. But yeah, so there's a few areas where this may affect us. Nothing too big, but basically like, like we have a dock where we bundle an adapter, and the dock is made outside China, but then we take the adapter wholesale and is shipped from China, and then just bundle that in with the dock. So
Mm-hmm.
under the transshipment rules, we would have to pay, I think, the 40% tariff on that adapter because it's a separately assembled, separately sellable item. But a lot of these definitions of what really falls under transshipment are emerging because it's a fundamentally new concept and they haven't
Yeah.
documented it fully.
Okay. Okay. Switching gears a little bit, Bernie, I know that you sell in international marketplaces as well, and obviously the tariffs, they're U.S. tariffs.
Yes.
So, I mean, how does that affect your international sales, and how are the sales going? And which marketplaces are you selling in?
Yeah. Well, we're selling all over the world on Amazon marketplaces, whereas in North America we're diversified Amazon, non-Amazon. Outside North America, we're largely Amazon only, and it just makes those sales more valuable because the U.S. has all of these risks, and so. we're eager to increase our sales outside the US, but so is everybody else. And so I think it's probably, creating or will continue to create a little bit of beneficial price pressure. I mean, there was already the Amazon world of thousands of brands selling every type of product has already created almost maximal price pressure anyway. But now, especially, there's a strong motivation to build sales outside the U.S., and we feel that too.
Hmm.
Um, Now, the one of the disadvantages we have is as a U.S. company, the U.S. has been kind of our logistical hub. Containers come to the U.S. and then we're often shipping out of the U.S. to these other markets. In with this sort of tariff regime, it's the worst possible situation to use your
Yeah.
U.S. as your hub, and so we have some disadvantage there that we know how to unwind. And you can, when you pay a tariff on goods coming into the U.S., you can claim that tariff back when you export. It's just paperwork intensive and causes a cash
Yeah.
delay. And there's also, customs bonded warehouses and free trade zones, which allow you to import the good without paying tax immediately. And so if you immediately re-export it,
Hmm.
you don't even have that claim back. But all of that is friction. And in this e-commerce, global e-commerce world, you can't afford friction. You got to get rid of all
Right.
of it. And
Right.
so,
Right.
yeah.
I mean, wouldn't it make sense, let's say, because I know you're selling in Japan, right? Because obviously I can buy your product here in Japan. Wouldn't it
Yep.
make more sense if, let's say, you shipped, part of that order going to the US, if you shipped it to Japan or, from
Absolutely.
Taiwan or Vietnam, and there's some free trade agreements within ASEAN, right? I believe like Vietnam to Japan, certain products can come in duty free. So I mean you'll be saving not only on the tariffs but also the duty rate, in addition to lower shipping time and costs as well. I mean like are you like how are you factoring that into like the future? Are you gonna put more resources into international, or like how does that look like, with your
Yeah.
strategy?
Yeah, absolutely. And it's the challenge is scale. You got to get scaled up to the point where, as you have your production batches coming off of the factory line, that you can have the scale to say, okay, we produced, 1,000 units or 10,000 units, and we're going to have 100 go to Japan and 200 go to Australia and 500
Hmm.
go to UK and 1,000, or whatever. And so the in many cases right now we're trying to get that scale so that at the SKU level with
Hmm.
or really at the factory level, that as we're finishing production batches, we have enough demand in every marketplace that we can ship direct from the factory. Because if we don't have enough demand, then we've got to have a outside the U.S. Warehousing or 3PL solution. And there's a number of those out there, and the really powerful ones are ones that are actually in your country of origin for the goods. I think partially because we in getting out of China, we allowed ourselves to get spread around Asia, which is one of the disadvantages actually, that it
Hmm.
means that it's tougher for us to get that critical mass of, okay, we've got enough production in this one country and it solves enough of our total problem set that if
Hmm.
we could have a 3PL there, like let's say a 3PL in Taiwan or something.
Hmm.
Um, so yeah, so I think it's the challenge for all brands right now is this, this what's happened with tariffs here in 2025 is you can't ignore it and it's complex. And the bigger you are, the better you are able to handle it in terms of legitimate uh, kind of avoiding the U.S. and avoiding encountering,
Yeah.
these new punitive tariffs.
Yeah. Okay. So to kind of close out and looking into the future, Bernie, how are you planning for Q4 this year and for next year, 2026? I'm not even going to say 3 years because that's not even realistic given how fast things can be changing. But what's your strategy?
Yeah, so I think our strategy is probably I could simplify it down to two things. I mean, one thing is just be realistic and in a sense allow yourself to be reactive. Like in this environment that's been created by the Trump administration, if you overplan something, the decision will be changed and your planning will be for naught. Like our 8-year effort to get production out of China, for example.
Mhm.
So you got to be reactive to the realities, and there are new costs with these tariffs, and you're just going to have to factor those into the business model and see where that lands you in terms of your ability to sell and your market share. But then the other side for us is just simply and this I think this was already happening because of the rise of Chinese brands. Sourcing a commodity product from a factory that's selling to the world, and has their own brand, on the side, that they're selling direct with super high efficiency and low cost. That sort of model is, you know, way less attractive than it was 10 years ago. I won't say, and I might even say that model is dead, actually.
Mhm.
And so, our focus at Plugable is more on innovative products. So we are doing more
Mm.
products where it is unique. We are doing the big upfront investments to develop new technologies, get them patented, take them to factory partners who are willing to do production just for us. It's not something that's sold to anyone else. Um, and in electronics, that's really expensive, but then it gives us, kind of the unique product where as long as that product is, appealing to the market, these issues around price and the impacts of the tariff become secondary to the value that the product delivers. And so between those two things, just simply being realistic and reactive, and then trying to
Mm.
innovate our way through all this, that's essentially the summary of our strategy.
Excellent. And what about AI? Like, how are you using AI like to achieve these goals?
Yeah, all over the place. I mean, internally,
Uh-huh.
all over the place. So
Mhm.
we've been aggressive about adopting AI. We've got every team member with a ChatGPT subscription. We are doing an enormous amount of internal AI-driven software development because the imperfection of AI-based software development is much more tolerable when you're developing internal automations. So it's still a little tricky with developing an externally facing product, but it's also becoming more realistic there too, and we're beginning to do that. We've got more hardware bundled with software, where the software part of that is significantly accelerated with AI. So it's kind of quietly like we're going to have some actual products that have AI as the features of the products coming up. You'll see some from us announced at CES 2026 here in 6 months. But the main thing that's already happened is a massive amount of internal AI use.
Mm. Excellent. Okay, Bernie, thank you very much. We unpacked a lot today. And if you were to distill down everything you shared to our audience, like let's say they're a seller looking to survive this, what would be the number one recommendation?
Yeah, the number one is probably just don't ignore it. It's if you're a U.S. company, you've been receiving messages from our government saying, well, hey, the other country is paying the tariffs. You just keep, you shouldn't be raising prices. You should just be able to, this is to your benefit. Hey, that's not true. So
Yeah.
you've got to analyze the actual impacts on your business and not be static. Because if you're static about this, if you don't make some tough decisions about pricing and sourcing and logistics,
Mm.
you're gonna get run over by this.
Yeah. Great advice. All right. Best of luck to you, Bernie, with Plugable going forward. And thank you, everybody, for joining us. We'll see you at the next session. Bye, everybody.
Thanks, Gary.